Welcome back. Well, let's focus on IndiaMART. The stock is up and about in today's trading session. I think it's up close to around 4%. So clearly the street liked what they saw in terms of their numbers. Mr. Dinesh Agarwal, the CEO of IndiaMART, joins us on the show. Hi, Mr. Agarwal. Good morning and good to see you in. Well, give us a couple of details. You know, earlier I was trying to push you with regard to the margins. And you said maybe they'll start moving towards around 30%. You managed to get them to around 28% as of the last quarter. What is the outlook on that front? And also if you could tell us what kind of subscriber addition you're looking at. That's still quite mediocre at around 2,700. Please go ahead.
On the EBITDA margin, I have guided you on the standalone EBITDA margin. And I think on the standalone side, we are about 30% there. And we would like to maintain that 30% run rate going forward from here. On the consolidated basis, because there are other businesses where we are investing, so you are seeing 28% EBITDA margin. On the customer front, as I said, last quarter was probably the lowest, and from there, last quarter was 2,000 and now we have 2,700. We are showing some recovery and still not as per the mark, and we are continuing to work on the subscriber addition and churn in the lower buckets of the silver monthly and silver annual. And hopefully in the next quarter or two, we should be able to get back to our natural level of 5,000-6,000 customers in 2-3 quarters.
Oh, okay. 5,000-6,000 customers, huh? That's a quarterly run rate. By when do you think you'll manage that? Because you're at about 2,600 in Q4. When do you touch 5,000?
I'm planning to target that by Q2.
Okay.
Mr. Agarwal, hi, good morning. So 5,000 by the second quarter. How will it happen, sir? If you can give us a sense, what's the strategy that you sort of employ?
So two things. One, as you remember, we last year increased the prices and it took some more time than usual it takes to absorb the prices. So gross additions have been slightly lower by 1,000 or so. That we are trying to recover, and we are on path of recovery on that side, as well as we have taken certain measures to control the churn, and I believe the results will start coming in over the next 6 months, and that should do the numbers.
Okay. So nothing on pricing per se. You're saying that it will get absorbed and naturally it will pick up. That's the.
It has already gone absorbed. I think the gross additions have come closer to the what it was pre-price hike.
Okay, all right. You know, I wanted to ask you about collections. Are you seeing any kind of upgrade of customers, you know, from silver to gold and platinum? Because I think that's the key trigger, right? Could you tell us how that is likely to pan out going ahead?
So effectively, if you see last entire year, our revenue or collection growth has come from the increase in the ARPU. And that ARPU has come up mainly from silver to gold and gold to platinum upgrade, as well as some realization increase. If you see constantly for the last 4 or 5 quarters, we have been able to maintain upwards of 10% ARPU increase. And that is coming because people are upgrading, people are seeing value in the product. And there are also some changes that we have done to increase the prices on the gold and platinum side.
Okay, so we're looking at more, are you looking at pushing through more price hikes? And that brings me to the overall question. I mean, for the year as a whole, if I talk about FY24, then growth came down quite a bit compared to the previous year. I mean, from 31% growth, you came down to 21% growth. But now that you're talking about, you know, higher number of customers and maybe some of these price tweaks, what are we expecting in terms of top line growth this year?
So revenue from operation, as I said, is a function of collections that we have done in the previous years. So if you see the previous years, collections were much higher, and that was reflected in the revenue from operations last year. And also, if you see last 2 quarters, our collections have been growing only at 16-17%, while the revenue was at 21% or 17% now. So I think since we have had a muted last couple of quarters on the collection as well as on the paying supplier front, you can see some pressure on the revenue. But as we improve the collections, the revenue should also improve going forward.
So can you go back to the 20% plus mid-20s kind of growth that you saw in collections in the first half of 24?
Yeah, I think if for the entire year, I can definitely I'm targeting to upwards of 20% growth in the collections, and that should reflect in the revenue going forward, maybe after 2 quarters.
Just one question, would you have to sort of undertake more spending on the tech side to kind of revamp the platform, etc.? I mean, will that be a kind of a added thing, or is that already kind of factored in with some of the numbers that you gave us on margins?
Yeah, it is already factored in, because if you see in FY23, we have increased the headcount as well as the product and technology cost by huge margin. And results of those are still awaited. We have been working on tweaks. Technology spend over the next 6-9 months. So the margins, we are pretty confident that we should be able to maintain a 30% margin on the standalone side.
All right, Mr. Agarwal, final question then before we let you go. You're at around 214,000 paid subscribers. Going by what you're saying, you'll be satisfied if you exit the year at around 235,000? That's doable, right?
I have not done that calculation, but if you have
mathematically, I'm just saying in this quarter, say it stays a little bit subdued of around 3,000 odd, and the next 3 quarters you do 5.5 to 6,000. So that will be an addition of 20,000, more than 20,000 for the year. So 235,000 should be a gettable number.
For the entire year, I'm actually targeting about 20,000. Yeah.
Got it. And final question with regard to the cash in your books, could you tell us what it is? And you've done some good inorganic growth actually. For the time being, margins are a little bit under pressure. But do you want to do some more inorganic growth, or is there a shareholders reward coming out?
So we have already declared a dividend of 20 rupees per share on top of the bonus that we given last year. So there's a dividend which has been declared right now. Last year we did around September, October, we did buyback of about 500 crores. So nothing on the cards in terms of the buyback or any extraordinary dividend as of now. As and when things fold out over the next 6-9 months, whether we get any good inorganic opportunity to deploy funds or not, will decide the future course of action.
All right, Dinesh, thanks very much. Good speaking with you. Appreciate you joining in. So upwards of 20% revenue growth, margins of 30% in that range. That's the sort of forecast as far as this chat is concerned. Good luck. Thanks indeed.